I'm very much an efficient person. If there's downtime, I will do something with that time. I was eating.
27,000 emails. Let's go.
28.
Good morning. Good afternoon. Good evening. This is the Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. Today we're doing a mailbag episode. We're doing all the questions, like all of them. So in our podcast, it's usually 4 segments. It's going to be 3 today because there's no content, but you get to learn about us professionally and personally. We answer all the questions and then we're done. So it's quick.
No content? You mean no questions? There's no questions because they're all questions.
Did I say it wrong?
You said no content. I didn't know what you meant by that. I'm just clarifying for whoever's listening.
If you came here to listen to Let's Dive In, it's not going to be here today. It's all
question.
What would you do?
Yes.
Okay. Jordan, go.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
We're a financial services podcast, so that's why you had to listen to that. So we're going to jump right into our segments. The first one is learning about what?
Wait, can I just say something? We look really good when we match.
Great, thanks for that. If you're listening to the audio version of the podcast, that meant nothing.
We're both in black t-shirts and it looks so good. It's on brand. We should do this more often. I like it.
Yep, my nails are painted red. I do have a blonde wig on. We look uncannily similar.
Ha, ha, ha.
Anyway, if you haven't liked the show, commented, subscribed, followed, send it to your mom, please do so now. So we're going into our first segment. It's called You Good? What's New? How you doing? What's up, Shorty? Heather.
First of all, I'm not short, buddy. But what's going on? I'm getting really close. I'm getting really excited. This is definitely my year of just really, as my firm has grown, putting in different processes, delegating so that I can be at my best for my clients, which is strategy and meetings. And as the more money I've managed and the more accounts, that is starting to take, I notice, a significant amount of my time. And so I found a CFA who's part of an advisor network where we can share trading. He used to trade like billions of dollars at a different firm. Where I can offload some of the trades. I just tell them the model and it's just implementation, which is fantastic. So I'm very excited about that because as I grow, just trading on all these individual accounts with how much my clients add cash every month, it's a lot. It's a lot. Mm-hmm. And so, yeah, I think I'm entering a boys club, Dave.
You're already in one.
I know, but I love being the female that just like breaks it all up and that's welcomed. It's so awesome. I'm like welcomed into it. I'm like, okay, that's exciting. I'm excited.
That's good. I like that.
Mm-hmm. What's going on with you?
So I mentioned it before. So I'm in this tax planning certification designation. There's 3 classes to it. I'm starting the second one and it's tax planning and retirement. If you're not aware of what my firm is called, it's called Retirement Matters. So these classes, I'm like, I open up the class, I'm like, I know this. I know exactly what he's going to say.
Isn't that the best feeling? That's the best feeling, though. I like when people just like, I'm like, oh, you're telling me I'm smart. Thank you.
Yeah. Some of it feels a little redundant because I'm like, okay, I do have to listen to you just in case you say something slightly different or it's a nugget because that could come up in an exam. But for the most part, I'm like, yep, did this last week. Thanks. Yep, my client just did that. And it's nice to go through content where, yes, some of it could be new, but some of it's just, I do this all day. Just because that's my focus.
I love that for you. You're very specialized in retirement. I could ask you.
All I do.
I know. That's why I love having you on my Rolodex, my virtual Rolodex. Okay. All right, ready for the questions? I love questions. Everyone knows I love questions. I love when people email us questions and we're answering them today. I'm so excited.
All right, so this is our segment called What Would You Do? Before we go into questions, we have a viewer who sent us an email full of questions, awesome questions, and we're going to tackle all, if not most of them today. They will go nameless. They've already been aware that this is the episode where all of their questions are answered, and so we're going to go right in. First question. What is the difference between an ETF and a mutual fund? You have 20 seconds, Mrs. Townsend, on the clock.
You can't answer that in 20 seconds. I mean, I think the biggest one, at least in my world, is there's two things. Mutual funds trade at end, like when the market closes. It's priced after market close. Why I don't like that is you are kind of blind at what it's going to trade at. Like capital gain, how much the capital gain, how much the capital losses, don't love it. So it's not immediately liquid like an ETF is. An ETF trades just like a stock. So it's going to give you the price and it's going to trade at that price during market open. And then ETFs are designed, they're much more tax efficient. So they don't give off capital gain distributions like a mutual fund does. Those are my two main things. I have found that mutual funds also come sometimes with more trading fees, at least at Schwab they do, depending on, right? They can have a trading fee of like 25 to 45. I don't even remember what the fee is, but they normally come with a trading fee. ETFs normally trade zero transaction fee costs. What am I missing here, Dave?
You can get very specific with an ETF. Like you could trade very specifically, or your focus could be very specific. Mutual funds tend to be more generalized. They can be focused, but with an ETF, you can get weird with it if you want your investment focus to go that way. They're a lot more transparent. Mutual funds typically disclose every quarter on their quarterly reports. ETFs, it's a daily thing because that's how they're trading. Like they have to be very transparent, making sure you know exactly what you're buying. And typically cheaper than mutual funds. That's been changing recently, but most of it is on the good side. It's hard to find bad side to an ETF. Other than in a volatile market, the pricing could be all over the place. Mutual fund tends to be they could be a little bit more stable.
And mutual funds, you mostly find them if you have an employer 401k. I don't think I've seen a 401k yet that has ETFs, unless it's a 401k that you can just open your own brokerage account at Schwab and stuff. But if it's a full-blown employer with a big corporation, mutual funds are normally what are in 401ks. And I think that's fine as long as they're good mutual funds. Mutual funds aren't bad. I prefer someone to invest in a mutual fund than a good one than be in cash.
Yep, agreed.
It's really what is the holding, I would say, to pay attention to this listener is it matters what the mutual fund is invested in. That's what you need to pay attention to.
Yeah, I think if you're investing in indexes, which 99% of the population should do, you're not going to find too much of a difference between an ETF and a mutual fund with the investment philosophy and approach. The mutual fund may start to drift a little bit more just because they may not be required to trade as often. And an ETF is just, so you're talking about tracking error. ETF should have very minimal tracking error. But yeah, that's pretty much it. We covered it.
Question 2. What are your thoughts of a target date fund in a Roth IRA? I really want to answer this one.
Go for it. I'll give you thoughts if they're different.
I mean, I say for someone who's doing financial planning on their own or their own, investing, I think target date funds are good. I wouldn't say they're great, but they're way better than you in some active mutual fund that, isn't, they're trying to outperform the market and probably don't, right? I'd prefer them to be in a target date fund. For my clients, though, I will say that target date funds are more conservative most of the time. And in my clients' portfolios in Roths, I most of the time are 100% equities. I look at their whole investments as a household, and they normally don't just have Roths, so they might have a brokerage and they might have traditional IRAs. The Roth, because we are not going to pay any taxes based on current tax law on those investments, on those funds, I am the most aggressive in a Roth IRA. I'm 100%. I would not put a target date fund in there.
Yeah, I think if you're a younger investor and Roth IRA is the way you're going, you don't have to build a portfolio. You can use a target date fund. However, be careful of the target date fund you choose. Because if you compare a Vanguard target date fund, say we're looking at Vanguard 2040, it's our target date, versus American funds target date 2040, they are going to invest differently, even though the date is the same and you think it might be the same. American funds loves being heavily US centric. Vanguard is typically going to build things and it's going to be very diversified. So just be aware of what you're picking, and you got to lift up the hood on a target date. You got to understand what the investments are inside of it, not just picking it based on the year.
What is your plan with your business when you retire? What would happen to your clients?
All right. So full disclosure, I'm 42. I don't know when I'm going to retire because this business can be whatever I want it to be. I could work with 5 people. I could work with 500 people and have a team underneath me. So it's an evolving thing every year. Let's say it ends up just being me and some support staff. The nice thing about financial planning firms is you can sell them. So the plan when I choose to retire, which is typically going to be a joint decision with me and my wife, I will probably sell it. What would happen to my clients? They would just transition to another advisor, another firm. I would stay along, help with that transition. But yeah, I'm not the only good advisor out there. There's plenty of other good ones who could service my clients and they would just be fine. So it's part of my financial plan as a business sale, but the value is question mark.
That is so funny that it's part of your financial plan. My coach gets so mad at me about that. I don't have my business in my net worth statement.
I would imagine your business is probably your largest asset.
I know. I don't. It's not in my net worth. I can't even. I know. It's fascinating.
But then do you have a contingency plan if you die?
Yes. Yeah, that I for sure have. Disaster recovery, death. Yeah. I mean, I even had to have it for registering in California. I have very detailed instructions for my best friend and husband if I pass. I think you're in the list, by the way, of where clients could reach out to.
Cool.
But yeah, they're supposed to contact a very short list of advisors and give them to my clients. And it actually says, if you are in this, I recommend this advisor. If you are this, I recommend this advisor. If I die, I don't think I would want my husband to have to go through selling my firm. That would be like so painful. And I'd want my clients to go to the advisors that I really know they'd be in good hands. That's what life insurance is for, right? So I definitely have that covered. Retirement, though, that's a really interesting one for me. There was a time when I moved to London for my husband's job, and I didn't have any job for like 9 months. That was the most miserable I've ever been in my life.
Yes.
No, I was miserable. It was awful. I need to be happy. I need my mind challenged. I would have my girlfriends are like, what? You have this wonderful boyfriend who doesn't care if you go shopping and go get coffee all day and you can just go meet girlfriends all day. And I'm like, yes, it's lovely for a day. It wasn't enough for me. There's nothing right or wrong with it. It just wasn't enough for me. So, I really don't, I think I'm going to be one of those people that does this until my brain, it's not safe anymore, right? My memory starts going, it might change. I might not have as full of a client list as I do now. Maybe I, have 10 or 20 less clients or something like that, but I love this work. So I'm 38 right now. My husband will retire way before me. I'm his retirement plan. So no, he's saved. He has money too. But yes, I don't plan to retire very young. I'm not one of those. I'm not like the fire want to retire at age 45, 50. Do I want to be in financial freedom early? Yes, but I don't want to retire early.
Yeah, that's good.
Oh, you
it's
like
an interesting thought. That last part, that financial freedom. I have the controversial take of, I don't know if I ever want to get there because I always have to chase something. else I'm like you, I'm bored.
Yes.
It's unfulfilling. I easily
Yes.
slip into a depressed state if there is nothing to chase.
Same. I love goals.
So selling my business is a little scary because I'm like, what do I do with all that time? I'm sure I'll fill it, but I don't know. And
I think that's why I don't have it in my net worth. It's kind of like that. Like I don't know if I will ever sell. I just don't see that. If you won the lottery, $20 million, Dave, you got $20 million from the lottery, how would you plan steps for looking to retire?
I'm not going to
Right?
retire because I just said if I retired now, it would not be good for me mentally, emotionally, everything. I need purpose.
Mm-hmm.
The first thing I would do is if I won 20 million, the number I have in my head that I need as a maximum is 10. So I'm immediately giving 10 million away. I don't need this. Lots of other people need this. I am very privileged right now. So if I'm taking 10 million, then I set my whole family up for life. Like it's invested prudently. It's helping my kid buy houses, fund education, do whatever they want to do, help them start a business. But at the end of the day, I'm not tied to money at all. In fact, if there's too much money that I have, I don't like it because I start to emotionally attach to that and get guilty. Because I'm a spender. I can easily spend it, but it doesn't do me well emotionally.
Oh, we should talk about that. What if you just if you give, is that like my 50-50 approach? Like, let's say you just had 10,000 extra dollars you made this month, right? If I said, go spend 5,000 to go get your Tesla and then you gave 5,000 too, would that then it's like dual purpose? Does that work?
I think it has to be bigger amounts than that because I've got goals I want to accomplish, house purchases, education, all those things. But if those were all accomplished and funded, and then I had an extra $100,000, I don't have a plan for it. And I've achieved everything I want to. Okay. So can I go below that? Not in good conscience.
I get that. Yeah. I definitely up my angel investments for what I talked about previously on, trying to invest in companies that are going to change the world for the better.
Yeah.
Maybe I'd really start my angel investment fund by that point. With all that, I could have my own angel investment fund. Like it's already named.
Yeah, if you had 20 million.
I already have an LLC for it. So I'd really front load it. I do the same, like set up family. But I would not stop working. I say this openly. I don't play the lottery. I have no want to win the lottery.
Right.
That doesn't, I think it is way more admirable if you are worth 20 million and you did it yourself. Mm-hmm. People who win the lottery are miserable. Everyone knows it's normally public record and most of them go bankrupt. They're worse off and they're miserable. No, thank you. Have no interest in it. But to answer this listener's question, steps for looking to retire, we've had a retirement podcast episode, right? I'd set up the buckets. I would direct them to that. They need to listen to that. And you can I'd be very surprised if you can't retire on $20 million. You have a spending problem if you can't retire on $20 million.
Number 5. I need to add funds to my portfolio, but I'm worried about the volatility and can't bring myself to invest. What do you recommend? Dollar
cost average. I've been doing this a lot with my clients this year. I think this was a weird year with the tariffs. I think the noise was louder than most years. Let's be serious. There was just a lot of noise and people were nervous, but I wanted them to stick to the plan. So again, Heather being openly manipulative, dollar cost average. I'm like, okay, well then we're going to throw it in. How about 1/3 each month? And it helps with the FOMO. That's really what it is. My clients were thinking, well, what if it goes down more? Right? I want to be able to capture that. So you dollar cost average in. I normally don't go longer than 6 months. It kind of depends on the amount, right? If it's $1 million, then I'll go out a year. But if it's, $10,000, $20,000, $30,000, 1/3 a month for 3 months, maybe something like that.
Yeah.
That's what I do.
I actually had a client who went through this 6 months ago. They're not a client because they wanted a one-time plan and couldn't bring themselves to invest the money. But it was over $1 million. It changed their life because they scrimped and saved their whole career, and then it was an inheritance. There's two sides to it. One, I think, is it actually about the volatility, or is it more about understanding what the volatility is? And
Great
should
way
you be
to.
buying low and selling high? Like all that technical knowledge. And if it's not about that, then what is it? Because there's got to be some emotional component to it that, as financial advisors, we are not qualified to dig into. Because there's got to be something holding someone back from a task that should have zero emotion attached to it.
I think if you're learning to invest, it's hard. I don't know. Some of my clients used to be really anxious about the stock market. And then when I put them through investing for the first time with me, regardless if they're new investors, they're retiring and they're coming over from another investor, I think pretty much every one of my clients has seen my favorite chart. And it's the chart of the S&P since 1900. Mm-hmm. And it just goes and shows that, and I point out the most recent stock market crashes, right? Like the 2008, COVID, even Black Monday, right? Depending on their age. When you really look out at the long time of the stock market, it's a blip, but it just feels so big in that moment. And so if you react, it's horrible. But in the long run, since 1900, which that's 125 years of data, it's normal. The stock market goes up and down. That has never changed. It's never just ever been flat, right? Just solid. So I'm really big on teaching my clients that volatility is normal. And that's why we don't invest money that you need in 3 to 5 years. I mean, retirees are a little different, but that's why we have the buckets. We plan for that, right? We plan for volatility. Mm-hmm. Volatility is part of investing. But leaving it in cash, no one got wealthy having money in cash. So what's your other option?
What do you do if you go through all that education and someone still can't pull the trigger? Because it's not an education problem at that point. It's something else.
Then I say exactly what you say. I say either you need to go to a therapist or you cannot continue paying me because I can't do my job.
Yeah.
I'm actually quite blunt with my clients. I think you are too. That's our personalities. That's why we get I want people to thrive with me. And if you can't thrive and do the things that you need to do to reach your goals, don't pay me.
So the short answer to this is educate yourself. And if all that education doesn't bring you to be able to pull the trigger, then you need to go find a therapist. Most of the time, not pulling the trigger I've seen is coming from money that was never yours in the first place. It got given to you. So inheritances typically. I've seen people melt just because of money going down or not being able to pull the trigger, and it's all based on relationship they had to the person who gave them the money in tragic circumstances. It's never about the money. Oh. So it's interesting.
I have not had that issue yet. Now I probably just put that into existence. Great.
I was going to say, The next one I find, I'll send to you because there's a lot.
There's a lot. Yeah. There are such things as financial therapists, which I think that's really cool. Should I put a rental property in an LLC? I just got this question from a client. I wanted to include that today to talk about it on what my advice was. So they're going to rent out.
Did you say every time?
No, I did not actually.
Okay.
This rental property is out of state and it is not a small, let's say small purchase price. It is a few $1 million. Okay. And so, I said yes, I recommend it because it's asset protection. Ideally, when my clients have rental properties, I want it in an LLC and an umbrella. An umbrella blankets over the LLC. That's like chef's kiss asset protection. Now, does it come with like fees for filing the LLC and more complexity? Yes. But at my client's net worth, that's what I said. I was like, this world is too litigious. We have to have asset protection. You're going to have renters in your property. Nope. So yes, I recommend LLCs for rental properties.
Do you recommend them for every rental property?
I think so. Yeah, if you can.
I was going to say yes. Yeah.
Yeah. I was trying to think of when I wouldn't, but and I think it does depend. I mean, as you layer on, you might have a holding company and maybe you put 5 in one LLC. I mean, ideally each property has a different LLC. That's ideal.
I think it's the mentality of it. Like, this is a business stream now, and you need to protect yourself from anything that could happen in that business. It's the same reason that our two businesses are either, they're not in our sole name. They're in an LLC, they're in an S Corp, and it's protection and all the other things that comes along with it. We're not just titling everything in our own name because that's unwise.
I have a disabled grandchild home for whom I have funded a 529 account. Can I move this account to a 529 ABLE account to meet their current needs?
All right, so let's do a little bit of education here. 529 account is saving for education costs. They're mostly for college. They can be used pre-college. An ABLE account is an account that you can use to pay for disabled expenses for a family member as they go through various treatments as a doctor has designated them necessary for their quality of life. The reason they're both labeled 529, that's just the IRS code that they fall under. So I have a client, their grandson is disabled. I'm not entirely sure. There's a big long name for the disabled, but I'm not sure if he's going to be independent ever in his life. That has been the evolving piece of, they didn't know that when he was born, and they funded a 529 when he was born for college costs 18 years later. And so now they're like, can we move this to a 529 account, the ABLE account, to now fund his disability expenses because we don't know if it's going to happen for higher education? The answer is yes, you can. There are some rules, though, and these rules are changing with new tax laws that are coming out. So you can open that 529 ABLE account. You can roll proceeds from the regular 529 account over. It's subject to the gifting limits of that year. So 2025 is 19,000. If you have an account that's over that, you can't roll your entire amount over. You also then can't contribute to that account because a rollover and a contribution counts as the same funding amount for that account.
Oh, dang.
Yeah. So there's different rules, and disability expenses can rack up pretty fast if they're not covered by insurance. So you do want to make sure that, okay, do you need all the money in this account, or is it going to be covered by insurance? You know, you want to go through that process of what care they need and how much money they need before you move the money over.
Can you do, I don't know if you looked
short answer, yes.
Can you do the 5-year, oh my gosh, do you know what I'm thinking of? The 5-year gifting where you can lump the 5 years, the IRS allows you to do that, where you can do a 5-year gift.
You cannot do that as a rollover from a 529 to an ABLE account.
Dang it. Yeah. Okay. Good to know. I've never had this.
You can do the 19,000 every year until you exhaust the 529 account.
It's an interesting thing with your client, though, that I'm just thinking out loud is like, that's a hard position to be in because it sounds like they don't know how disabled the kid is going to be yet. So, or if he could then maybe still need higher education, like what if they put it in the ABLE? Can you roll it back to the 529? This is an interesting, I wouldn't say fun one on this one because it's sad, but it's an interesting planning item.
It's very niche.
Yes.
Yeah.
Yes.
I had to do a lot of research and calling different advisors on this as to what happens here. And then each state has its own ABLE plan, just like they have their own 529 plan.
Of course. Yeah.
Some of them are with Fidelity, so it's nice and transparent. Some are not, and it's not as transparent. So and some have state advantages with tax exemptions, and some don't. So it's a whole world that I knew nothing about until 2 weeks ago.
Well, to end on a positive, how amazing, though, that your client is able to help out their kids with a disabled kid. That's beautiful. I mean, that's the good side of money, right? Like it helps. It just does.
It does. It makes life easier.
Yeah. Yeah. All right. I think that was a lot of questions today.
All right. So questions are over. Let's go into highlights. Highlights is our personal win of the week or what you're recommending. Heather, you can go first.
Okay. So I'm doing it again. I'm going to Park City again for my 4th summer. Same place we're renting again. And I literally call up the rental company and I just state my price. I mean, we just offer, I get it way below what it would be on Airbnb because we're renting for so long. And I get it for the whole month. And I'm really excited for going back. Okay, what's your personal win? I can't wait. Yours are always like, is it TV? Is it something about video games? Is it pickleball? What is it?
So this one is a PSA to be careful in yoga. So I have a ruptured disc in my back. So I have to do yoga to keep the muscles loose, else they get really tense trying to protect everything. And then it goes from my mid back all the way down through my calf muscles. So I have to do it. I overstretched in yoga. I pulled a muscle in my knee that was reconstructed 15 years ago. And I could barely climb up the stairs. Like it was one of those ones where it's like triggered my hamstring, it triggered my calf muscle. I could barely lift my leg, all from doing a knee stretch. And I'm like, oh, I feel so old at this point, old and out of shape, because I know that old people do yoga and are great. I just felt the out of shape old. Yeah. Anyway, tangents. So Thank you for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts, and the video episodes are on YouTube, LinkedIn, and Instagram. If you want to email the show, just like people have done to get into this episode, you can contact us at hello@playbookotw.com, and we'll see you next time.
It's hello@playbook, not POTW. It's playbookotw.com. Yeah?
What did I say?
That's what you said.
Hello@playbookotw.com.
I have just noticed that this entire time. I thought it was POTW.com, but it's playbookotw.com. Okay. Yes.
Yeah, POTW is taken.